Good morning and welcome to the Killik and Co Market Update. This week there have been lots of headlines about oil-related profits given the rise in oil prices that we've seen over the course of this year. Back in 2015, the oil price actually dropped quite a lot, and at this point many oil companies worked very hard to take a lot of cost out of their operations, and this means that many of these companies are now profitable when oil is above $50 per barrel. So for this year, oil has spent a lot of its time above $100 per barrel, so a lot of money has been made by many of these oil companies. This week, Saudi Arabia announced that its economic growth rate for this year is expected to be 8.5%, and that's because the country is making so much money from oil. Also this week, US oil major ExxonMobil has announced that it will be spending $50 billion buying back its own shares, which will greatly benefit its shareholders. The US government has been very critical of this move, and many are of the view that some of this money should be spent on developing more renewable power. This chart here compares the Exxon share price in the pink to the S&P 500 in the green. Exxon is up over 60% over the course of this year, whereas the S&P 500 is down over 15%. However, the story looks very different over 5 years rather than 1 year. You can see the divergence in the performance between the two in the months following that first lockdown. The 10-year story looks very different again. Despite the recent rise in the Exxon share price, Exxon shares have actually spent much of the last decade in negative territory, whereas the S&P 500 has performed strongly despite this year's drop. And also this week, China has further eased its COVID restrictions following the protests that we've seen across the country over the last couple of weeks. Markets have broadly responded well to this. Here's the MSCI China Index over the last 5 years, and you can see it's picked up quite nicely over the last couple of weeks. We've also seen a rise in the share prices of companies that make a lot of revenue in China, for example the big miners such as Rio Tinto. Although the easing of restrictions in China is welcome in some ways, the timing does feel a bit strange, and it does feel as though it's a bit of a snap decision. The restrictions are being lifted just as we head into winter, and there isn't that much capacity across the Chinese healthcare system to deal with a wave of sickness. It's also true that the vaccination take-up across China hasn't been particularly high. For example, only 40% of the elderly in China have been fully vaccinated. The data about the number of COVID cases across China has also become quite questionable of late. For example, the latest set of official figures showed that the number of cases had dropped over the last month, which doesn't make a lot of sense given the fact that the restrictions have been lifted somewhat. Further lockdowns in China would not be a surprise, and it's likely they would not be taken well by the market. And finally, the US Federal Trade Commission is trying to block Microsoft's acquisition of video gaming company Activision Blizzard. Microsoft already owns Xbox and is trying to expand its footprint into the video gaming market. In its last annual report, Microsoft pointed out that over 3 billion people in the world currently play video games. To put the value of video gaming into context, the highest grossing film of this year was Top Gun: Maverick, which took $1 billion in its first month. The most popular game was Call of Duty Modern Warfare 2, and that took the same amount in just 10 days. So it's clear why Microsoft wants to buy Activision Blizzard, but there's a lot of opposition to the deal and it's not going to go through easily. Moving on to have a look at next week, it's pretty quiet as we head into Christmas, but we have got results out from Accenture. That's it from us. Enjoy the weekend, and we'll see you next Friday.